Hi everyone, welcome back. I'm Ruben Torrens, and today I'm going to give you another tip on how to get more money at retirement time, how to increase your pension income, even if you get to retirement totally dependent on government pensions, if you don't have any employer pension or if you don't have any personal savings. So these strategies are complex, they require complex calculations. So make sure that you deal with a financial advisor preferably, or you really truly understand the whole concept. Because on the examples that I give you, if you change anything, if you change the age of the participant, on my example, or if you change the number of years of Canadian residency, or anything that can be different, income tax, whatever it is, it will change all the numbers around it, everything around it. So it's never going to happen. We're never going to get two cases that they look exactly the same. So, being said that, I always tell my clients to look at the big picture. Just look at the whole picture of retirement. And what is it? Well, you will spend in retirement, give or take 20 years or even more. So, just look at the income for 20 years because if as a consequence of doing the appropriate planning, putting the effort, or paying someone to a financial advisor to do it on your behalf, so you can increase your income by only $50 per month, which for sure, most likely, you will increase the income by more than that. So that will represent $600 per year and $12,000 in 20 years of retirement. So if you do your exercise, you'll pay somebody a few $100s to run your retirement and it increases your income by $50 per month. Well, it's adding $12,000 to your lifetime retirement income. So it is more than worth it. So it will be you will be in a great advantage. So also make sure that you subscribe to the channel because I will continue to give you tips on how to increase your pension income. So let's get on with the case. I work out a case from a real client. I only changed the names, of course. So Fred and Lisa at and I changed a few things because this client actually has some personal savings, but because the personal savings are on tax-free savings account, the client qualifies for guaranteed income supplement. And as long as the client qualifies for the guaranteed income supplement, this strategy works. Just let me show you how this thing works. Here we have the case of Fred and Lisa. Fred is 61 years old and Lisa is 60 right now, this year. They're planning to retire when Fred turns age 66 and Lisa age 65. Actually, Fred will start working at age 65, but will wait to claim his CPP and all the security until age 66 when Lisa turns age 65. So what we find out is that when we call the Canada Pension Plan and ask for a pension estimate, is that in today's dollars, and everything is based on today's dollars, Fred will receive at age 66 $758.80 per month, and Lisa $400 per month. Also in today's dollars, because they have 40 years of Canadian residency, uh, they will receive maximum all-day security that today in June of 2024 is $713. And with this income, because they don't have any other income that they have comes from a tax-free savings account, they will get guaranteed income supplement, $305 each of guaranteed income supplement. So in total, they will get from the government pensions $1,777 for Fred and $1,418 for Lisa, for a total combined of almost $3,200 per month. So this is what they have in mind. This is the idea that they had. And then when they show me their plan, what they were trying to achieve, I make a little change. I suggested this. I said, well, if the CPP will be 758 and 400 at age 66 and 65, why not taking it now at age 61 and 60? So Fred is 61, Lisa is 60, and take a reduced CPP. But careful, this reduced CPP will be reduced for the rest of their lives. But they're working right now, so they're paying income tax. So this money is taxable. And because their income is quite good, they're on a marginal tax rate of 29.65%. They live in Ontario. So every month, Fred will have to pay from his $498, $147 in taxes, in income tax, and Lisa, $75.90. So leaving them with $350 for Fred and $180 for Lisa, at least until they turn age 65 and they stop working. So when they're not going to pay any more this horrendous income tax. So here is what happens. By the end of every month, they will get this money deposited on their bank account. We will instruct Service Canada or Canada Pension Plan to deduct this tax every month. So every month, by the end of the month, they will receive this amount on their bank accounts, and they will instruct their banks to get this amount and deposit it into tax-free savings account for 5 years. If they are, we assuming they will earn 4% interest, in 5 years they will have accumulated, and even if they don't earn any interest, which is not the case, it, Fred will have about $21,000 because he will have $350 times 60 months, which is 5 years. So Fred will have $23,000 and Lisa will have almost $12,000 invested in a TFSA, in tax-free savings account. So the total combined tax-free savings account will be in excess of $35,000 by retirement time. But here is what happens when they reach age 65, 66 and 65. So now they will continue to receive in today's dollars the reduced CPP for both of them. And there is something that even financial advisors do not understand correctly how it works, which is called post-retirement benefit. How does this work? Well, they will take their CPP at age 61 for Fred and 60 for Lisa, but they will continue working. If they continue working, it is mandatory because they are under age 65 to continue making contributions to Canada Pension Plan. So every year, Canada Pension Plan will issue a new amount of post-retirement benefit. If we add this new amount for Fred for 4 years, because he's age 61 and will work up to age 65, so these 4 years, Fred will receive in total $111.91 of post-retirement benefits in today's dollars. And Lisa, for 5 years, because Lisa will work from age 60 to age 65, receiving Canada Pension Plan, she will receive an extra $133. So this will bring their total Canada Pension Plan benefit at age 66 and 65 to $610 for Fred and $389 for Lisa. The post-retirement benefit, you can have many post-retirement benefits because if you take your CPP at age 60 and then you continue working and contributing to Canada Pension Plan all the way to age 70, you will have 10 post-retirement benefits added together and added to your Canada Pension Plan. So in this case, they will do it only up to age 66, up to age 65 in reality, because Fred will work only up to age 65. With this Canada Pension Plan and the same all-day security, because we're always dealing in today's dollars, they will have a little bit more of guaranteed income supplement, so, but still will have less than the original amount. So they will have $3,115.92 combined of pension income coming from the government. But here is what happens. So if we get to the conclusion, we will see that the original plan was to receive $3,196. Because I suggested to change this, they'll receive only $3,115. So they have a loss of $80 per month. But what happens is that they have the $35,000 in tax-free savings account. And if we use my calculators on my website at pensionbooster.ca and you use the income calculator, you will realize that they can comfortably withdraw $175 per month from their TFSA account, increase this $175 by 2% every year to offset inflation. And if they do this, well, if we take the $80.74 from 175, they have a net monthly gain of $94.26 compared to their original plan. So this, when we annualize it and we project it over 20 years in retirement, will come up this exercise to an extra $22,600 on their pockets. So this is why at the beginning of the video I said that it is worth it to either do the homework, do your reading, and make sure that you get your numbers correctly, or pay a financial advisor to do the math for you and make sure that you have the maximum possible income by taking advantage of all the opportunities that you have, including the guaranteed income supplement, the new retirement, the post-retirement benefit and Canada pension plan, and so on. But there's so many opportunities that we have to increase that income by planning correctly. And I hope I didn't confuse you too much. The post-retirement benefit, it is complex. It is one of the latest benefits that has been introduced. Is fairly new. This is the reason why so many people do not understand how this thing works. But if you have any questions, you can call me. I offer 30 minutes at no cost to review your plan, your existing plan. And and make sure that you talk to, if you don't call me, make sure that you talk to a person that truly understands how these things work. And let me know in the comments if you agree with me that $50 per month can be significant, because most people, no matter what their income is, they cannot commit to lose $50 per month just in exchange of nothing, which is what happens when you don't have the appropriate plan. So other than that, thank you for watching. Don't forget to subscribe to the channel so you don't want to miss the upcoming videos. And I will see you soon. I will see you in the next video.